Okay, hi everyone. Today we're going to talk about this topic, tax exemption schemes for Singapore companies. Okay, so what are tax exemption schemes? Okay, imagine your company has a profit of 100,000 Singapore dollars. This 100,000 Singapore dollars, right, will need to be charged. So this is considered chargeable income. And the tax that is levied on this chargeable income is a corporate tax rate which is fixed at 17%. Okay, tax exemption schemes, what it does is that it removes certain portion of this chargeable income so that the company's eventual chargeable income is actually lower. What this means is that no taxes will need to be paid on exempted chargeable income. Okay, and depending on the qualifications that your company may fit into, right, the exempted chargeable income amount might be different. Okay, but this is actually a scheme by the Inland Revenue Authority of Singapore to lower the chargeable income of companies. So it's essentially lowering the effective corporate tax rate for your company. Okay, so there are two tax relief schemes that help companies to reduce their tax bills, and we'll go through them in depth, and I'll give you some calculation examples so that you can understand how to do the calculation for the tax exemption scheme for your particular company. Okay, the two tax relief schemes, right, are firstly the tax exemption scheme for new startup companies, and then the second one is the partial tax exemption scheme. Okay, so if you qualify for the first one, then you go under the tax exemption scheme for new startup companies. If your company doesn't, then it falls into the partial tax exemption scheme. Okay, it's quite simple for that to understand that. Okay, so usually you look at the tax exemption scheme for new startup companies, and like I mentioned before, right, this is the more attractive tax exemption scheme. So if you are new startup company, right, you need to properly declare that you are a new startup at the point in time where you are filing your company's corporate tax returns. And just for your information, right, the tax return deadline for companies is on 30th November this year. Okay, so the tax exemption scheme for new startup companies is granted to qualifying new companies for their first 3 consecutive years of assessment from their incorporation. So I'll give you a breakdown of how to calculate your first 3 consecutive years of assessment, and you need to uh, make sure that you qualify. So the company needs to qualify as well. So there are two criteria. One is the qualifying criteria, then the next one is the first 3 consecutive years of assessment. Okay, so the 3 qualifying conditions, right, is number one, the company must be incorporated in Singapore. That means that it is a company. Okay, it's not a sole proprietorship, it's not a partnership, but it's a company. So you can see your UEN number, right? Then you can see the year of incorporation in front. So you see, let's say you incorporated in 2022, then you will see 2022 something 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 something, then the alphabet at the back. Then that is a company. Okay, if you are a sole proprietor, then obviously you don't qualify under this tax exemption scheme because it has to be a company that's incorporated in Singapore as well. If you're a foreign company operating in Singapore, you also don't qualify for this because well, your company is not incorporated in Singapore. Okay, and the company must be a tax resident in Singapore for the year of assessment. Okay, what qualifies as a tax resident, right, is that its control and management of its business, right, is exercised in Singapore for that particular year of assessment, which means that if effectively the managing or the operations office, right, or the decision making people, right, they are operating out of Singapore. Okay, and the third one, right, is that the company's total share capital has to be beneficially held directly by no more than 20 shareholders throughout the basis period. So if you have like, let's say like 30 shareholders or 40 shareholders, then that doesn't qualify, and all the shareholders have to be individuals, or at least one of the shareholders is an individual holding at least 10% of the company's issued ordinary shares, which means that it cannot be like all small shareholders. One of the shareholders needs to be an individual natural person holding at least 10% of the company's issued ordinary shares. So if let's say you have one person who's like 10%, then the other, let's say you have another 15 shareholders, then these other 15 shareholders, they can be holding in all different percentages, like maybe 6, 5, 4, 8. Okay, but at least one person has to hold 10% of the company's issued ordinary shares. in most cases, right, especially when there are maybe 2 or 3 shareholders, this is not an issue. Okay, this only presents itself as an issue when there are like 20 odd shareholders, 30 odd shareholders. Then it's possible for all the different shareholders, right, to be owning a very small portion of the company, such that no one shareholder who's an individual holds at least 10% of the company's issued ordinary shares. Okay, essentially, we are looking for Singapore companies who are tax resident in Singapore, and this third criteria in most cases for new startups would be fulfilled. Okay, and then right, if the company, if the startup right is an investment holding or property development company, which means that the principal activity is investment holding or property development, then you don't qualify for that already. Okay, the principal activity should be the first one. So you can see you got one SSIC code and then the secondary SSIC code. The first SSIC code, right, should not be investment holding or property development. Okay, and then the computation of the first 3 consecutive years of assessment, right? Because for your first year of assessment for a company, based on the Companies Act, the company can extend its first financial period, right, to 18 months. So that's the maximum that it can stretch. Usually what will happen is that, for example, if the company is incorporated on 1st of October, then the company will say, okay, I want my first financial year, right, to end on 31st December the following year, which means that the first financial period is more than 1 year, because it most probably will be like October, November, so it will be 15 months, and this is possible based on the Companies Act. But whenever you exceed 365 days, for the calculation of first 3 years of assessment for tax exemption for new startup, IRAS will deem that as 2 years of assessment. Okay, so I give you an example. Okay, so if the company is incorporated on the 1st of July 2022, okay, and has its first financial period as 1st July 2020, this is 2021, okay, and has its first financial period as 1st July 2021 to 31st December 2022, which is 18 months instead of 12 months, then this will be the first 3 consecutive years of assessment. Okay, so the IRAS, right, they will, if your year of assessment exceeds 365 days, then it will be counted as 2 years of assessment. Okay, so essentially this year 1, this is 1st July 2021 to 31st December 2021. Okay, this is only 6 months. Okay, then they will qualify this as 365 days and 365 days. So if you calculate out, right, this is the total of 913 days. Okay, which is not ideal. So usually, like clients, right, when they incorporate a company, we want to maximize the period that they are deemed as a new startup by IRAS. So what do we do? Okay, I give you another example, right? Alternatively, the company can keep its financial period as 365 days from the date of incorporation. Okay, so you see in my first example, this here, right, the year 1 is only half a year. So then year 2 and year 3 is 365 days. But in this example here, right, we keep it as all 365 days. Then this will give us a total of 1095 days, which means that the financial period for the first financial period is 1st July 2021 to 31st June 2022. Then we follow suit. After year 3, if you want to change the financial year end, you can. Okay, so we would normally recommend clients changing their financial year end after the 3rd year. Okay, when this tax exemption scheme for new startup companies is exhausted already. Okay, so the calculation for tax exemption, right, for the first 200,000 of normal chargeable income is 75% on the first 100,000. Then after that, the further 50% on the next 100,000 of normal chargeable income. So normal chargeable income refers to income to be taxed at the prevailing corporate tax rate, and the prevailing corporate tax rate I mentioned is 17%. So basically, you hear it as chargeable income, right? Just take it as profit, okay? That's a simplistic way of saying, but in most cases, right, that is true, okay? So you just imagine if your company turns a profit, you have to pay tax. Okay, so the first 200,000 of profits, right, you need to pay tax. Okay, first 100,000 there's a 75% exemption, which means that if your company makes 100,000, you only need to pay tax on 25,000. Then the second 100,000, right, if your company makes 200,000, the second 100,000 you only need to pay tax on 50% of that, which is 50,000. Okay, that means that the first 75,000 IRAS imagine that never happen, like never see. Okay, then the second 100,000, the first 50,000 I mean sorry, the 50,000 out of that one second 100,000, IRAS also imagine that never happen. Okay, so you can see here, right, 125,000 out of 200,000 profit, right, IRAS will deem like as though it never happened, means that no need to pay tax on that. They only tax the company based on 17% of 75,000. Okay, this one is quite important, you have to really understand. Okay, this is exactly this is what I mentioned. So you can see so the balance of 25,000, then the normal chargeable, the second 100,000, right, you need to pay 50,000. So the total tax payable is 17% times 75,000, which is $12,750 for a profit of 200,000. Okay, we next example, right, is normal chargeable income is 80,000. So it's 75% of the first 100,000, right? So it's 75% of 80,000, which means that there's an exemption of 60,000. The balance taxable income, right, chargeable income is only 20,000. So it's 17% times 20,000. The tax on 80,000 profit is $3,400. What happens if the chargeable income is 150,000? So there's an exemption of 75,000 for the first 100,000, 75% of the first 100,000, right? So you leave a balance of 25,000. Then there is a further exemption of half of the next 100,000 profits. So because your next 100,000 you only profit 50,000, so half of it is 25,000. So the normal chargeable income is this 25,000 plus 25,000, so it's 50,000. You take 17% times 50,000, you get 8,500. Okay, and then the final one, right, the normal chargeable income is 350,000. So the exemption for the first 75,000 or first 100,000, leaving a balance of 25,000. This is actually the same as example 1. So the next 100,000 is half, right? So this is 25,000 and 50,000, but there's no exemption on the next 100,000, which is above the first 200,000. So this whole 150,000 above 200,000, which makes up the total of 350,000, that is all taxable. So you will take 150,000 plus 50,000 plus 25,000, total is 225,000. Then the tax payable is 17% of 225,000, which is $38,250. Okay, so the tax exemption scheme for new startup companies, right, this is how you calculate. Okay, so I gave you all 4 examples, and you should be able to fit it into either one of these examples. Okay, next, right, we talk about the partial tax exemption scheme, which means that if you're not a startup and you don't qualify for the tax exemption scheme for new startup companies, then you fall under this partial tax exemption scheme. Okay, so in most cases, right, I mean those what we call mature companies that already passed the first 3 years of incorporation, then you most probably will fall under this. Okay, so the calculation for tax exemption, right, on the first 200,000 of normal chargeable income, 75% exemption is on the first 10,000. Then a further 50% exemption on the next 190,000. Okay, so normal chargeable income refers to income tax at prevailing corporate tax rate. Like I mentioned before, the prevailing corporate tax rate is 17%. Okay, this one don't need to see the year or whatever. Okay, so if you don't qualify for first one, then you just fall into the second one. Okay, the calculation, right, if you can calculate the first one, then you most probably can calculate the second one. So you can see, right, the first 10,000, right, got exemption of 75%. So the if you make 200,000, then the first 10,000 the IRAS only see 2,500 of it. 75,500 they don't see. I say don't see so that it's like they don't consider that as your chargeable income, because this 7,500 is exempted chargeable income. Okay, so there's a further 50% on the next exemption of sorry, this is exemption of 95,000 on the next 190,000. Okay, this is 95,000 on the next 190,000. Okay, so the normal chargeable income, right, for this would be, since I did some calculation wrongly, right, then I most probably will do it here. So this is 95,000 plus 2,500, which is 97,500. So the total tax payable, right, is 17% of 97,500, which is $16,575. Okay, so example 2, right, the normal chargeable income is 80,000. The exemption of 7,500 on the first 10,000. So the first 10,000, 75%, this one standard. Okay, you leave a balance of 2,500. So there's a further exemption of 50% of the next 70,000, which is 35,000. So altogether, the normal chargeable income 37,500. Then your tax payable is 17% of this, which is $6,375. So next we consider chargeable income of 150,000. Okay, so there's an exemption of 7,500 for the first 10,000. Same, you leave a balance of 2,500. Then there's a further exemption of 70,000 on the next 140,000, because it's 50% of the up to 200,000. Okay, then you leave so you got 70,000 plus 2,500 is 72,500, and this gives you tax of $12,325. So finally, right, we calculate the 350,000 example. Okay, your exemption of 75,000, this one is the same. So this is further exemption of 95,000 on the first 100 and next 190,000. Okay, so this one, right, your chargeable income, right, is 97,500 plus 150,000, which is 247,500. So the tax payable is 17% of 247,500 is $42,075. This is the calculation for example 4. Okay, let me explain to you. So the consequences of non-compliance, right, is IRAS, they will if you are not audited, or if your company don't need to file Form C, then you don't need to submit all the supporting documents. Or if let's say you're not GST registered, then because GST registered, we need to file GST every quarter minimally. Then so your documents the company will keep. But what happens is that a lot of people think that the Inland Revenue will never come and check. This is not true. Okay, so this is quite recent. October 20th, 2023, there was this article on the local news. This is from Business Times. I think they ran similar articles on Channel News Asia and Straits Times as well. So the Inland Revenue Authority of Singapore, right, recovered 79 million in taxes, penalties, and following audits on companies. What it did, right, was it's random. So like some of our clients, right, they actually receive letters from IRA saying that okay, I know you filed this amount, but can you come down and produce all your supporting documents? And you need to do your record keeping. Okay, record keep for how long? So if you file this year, right, you need to keep at least 5 years from the relevant year of assessment. So if your year of assessment that you file is 2023, which is this year, you file for last year, then you need to keep the record for 5 years. So what record do you need to keep? You need to keep things like invoice, receipt, payment vouchers, any other supporting documents. You cannot say I estimated that I spent 20,000 on expenses. You cannot say that. You have to show that there were bills that came in, then you make payments on these bills. Then the receipts that you make these payments, then this will qualify as expenses. You cannot say I think I spend this, and you cannot say all these are all entertainment expenses. They might query like, okay, like you spend this entertainment expense for which client, for what purpose. Then you need to show records as well. Okay, and there's a cap on the deductibles. So like expenses on entertainment, all this, right? There are caps on the limits as well. But this is another video that we'll cover on another day. Okay, so you have to save it as hard or soft copies. Usually what we'll do is that we will tell clients that you need to get like a proper accounting software, and the one that we use is Xero. So Xero, what it does is you can actually store all your records inside Xero, soft copies. Then you work from there. Okay, so these are the deadlines. The estimated chargeable income, right, to be submitted within 3 months from the company's financial year end, except for companies which are exempted. Which means that if the company don't make any profit, then there's no chargeable income. Then don't need to estimate because the chargeable income is zero. Loss or no profit. Okay. Then corporate income tax returns, right, to be submitted by 30th November. So like now, right, it's end of October already. So my company is quite busy helping quite a lot of clients file their corporate income tax returns. Form CS or Form C. Okay, to be submitted by 30th November. Okay, and if you got any queries, right, you can contact us. You can email us at info@Singapore Secretary Services. This is our corporate site, rafflescorporateservices.com. Then our price list, right, and services are all on singaporesecretaryservices.com. So if you want me to cover anything, right, you can also email me. Just email info@Singapore Secretary Services saying that you would like some topics to be covered. Essentially, this tax exemption scheme for Singapore companies. Someone actually emailed us to ask us to cover this, and that's what I'm doing today. So if you got any queries about this, you can email us. Just email us to ask us about how to do your tax computation. If you need any help with filing your corporate taxes or accounting matters, you can always contact us as well. Okay, so that's all, and I'll see you guys at the next video. Bye.